Okay.
We've heard about a bunch of kind of macro trends, I feel like, today, from the growth of AI and data centers to climate risks and property risks, as well as trends within the industry. I mean, we've talked about MGAs and fronting carriers and kind of how private capital is disrupting insurance. So, not to start with a softball question, what will the industry look like in 15 years? I mean, tell us a little bit about how all of those trends, where they're taking us, basically, and maybe what will be most different, in your view, 15 years from now in the insurance sector.
It'll look different. Next question. Just kidding. Yeah, look, it's really interesting. And I think it really was a kind of a good sort of segue into all the discussions that were had over the course of the day today, which are quite interesting and really emblematic of what's going on. So the way I kind of think about it is, and my bias is we are, of course, the Ascot Group is a specialty insurance reinsurance organization. So that's the lens I'm kind of looking at this through. But I think we can take a step back and just maybe take the altitude up a little bit and say, what are some of the kind of macros or the thematics that are at play? You mentioned many of them. But what does it really mean for business models going forward? So if you think about those macros and how they apply, every company and many of our trading partners that are in the room here, wonderful companies, everyone though has a little bit of a different strategy. And so the question really, I think, comes down to any operating model is really built to deliver a strategy against a bunch of sort of macro themes. And so I think you're seeing lots of evolution along those lines as we sit here today. And someone used this phrase a while ago, and it really sort of stuck with me, and hopefully all of us as risk professionals. But risk has never been a regressive function like in the history of mankind. I have no idea what Microsoft's new Office suite will be. I assure you it's not Windows 98. It doesn't go backwards. So as we kind of think about the emergence of risk, we think about all these trends, what it means for business models, I think you're going to see lots of innovation. I am equally thrilled, excited, and petrified by the technological freight train coming down the track. So I think we're going to see lots of new entrants, new models, and again, I think a lot of the themes today are probably giving you the seeds of what those are going to look like.
Great. I mean, maybe just on the capital side, which has been a big theme today, I guess when we were speaking earlier, you sort of said historically the industry grew up with balance sheet capital, then you really started to see the rise of ILS, which has obviously become a much more mainstream, bigger provider of capital, 144A. Then now you're seeing the launch of kind of sidecars and ILWs and all kinds of other vehicles through jurisdictions like this one. Does that mean that traditional reinsurance capital is obsolete, or what role do you see more traditional sources of capital playing, and again, sort of where does it land a decade from now?
Yeah, I think it's a great question. I think I try to look at this through the lens of an ecosystem. Like when the insurance, if we think back over many years, we all live in an ecosystem here, and that had multiple forms of capital, multiple contributors. I think capital proliferation is inevitable. So I don't think it's an either or. I think it's an and, is sort of what I would say. So I think balance sheet capital is critical, will remain critical. I think you'll have a growing roster of both on and off balance sheet capital in addition to ILS. But the other kind of trend that's really interesting is, we should add into the capital equation client capital. Look at the captive formations over the last 2-3 years. I saw a stat the other day. There's 80% of Fortune 500 have a captive. So capital's coming from lots of different angles, lots of different perspectives. And I think you're seeing lots of different mechanisms to bring that capital to bear, both from many of the innovations here, some of the innovations out of London, and I'm sure many others to follow. So inevitably, as there is an attractive return profile, it's going to bring more capital through lots of different dynamics. But I think you can expect that to continue. The real question back to that ecosystem is how do you use it? How do you put it into a cohesive strategy that delivers for all your constituents? And that's, I think, what that business model discussion will come back to the forefront.
We're in Bermuda, obviously, and another topic I've been so interested in is just how Bermuda remains competitive globally and continues to kind of grow its status as a reinsurance hub. Do you find as Ascot that there are more jurisdictions kind of competing for your attention and for you to set up shop there? And how do you think about the trade-offs of where you operate?
Yeah, so we are, we're a proud Bermuda-based company. We really thrive in the jurisdiction here. We think our regulator is thoughtful. I think you heard a lot of the commentary earlier about great governance, creating great outcomes. But there's also a lot of knowledge here. And I think for all of us, we all want, one of the number one things we're all looking for, what our boards are looking for, is predictability. So to the degree you can understand the environment you're in, to the degree you can chart a course with a reasonable time scale ahead of you, it makes life a lot easier. And there's a level of sophistication, so we can do things a little quicker here. But so we operate, obviously here, we operate in London, and we operate all throughout the States. And so for what we do, that covers a lot of the flow for the business that we're looking for. And yes, the answer is yes, people are competing for that, and there's lots of different ideas, which we think is good. We think it's healthy. We think it's again, I don't see it as, I see very few things as either or. It's just a different part of our ecosystem and how we might kind of plug in where it makes the most sense for what it is we're trying to achieve. But I think that's a real healthy debate and dialogue that should continue, and I think there's a good level of kind of transparent dialogue among the regulators as well, so there's at least some sort of common baseline. But
what of the jurisdictions you mentioned, that's all expected. There's been more attention recently on the Cayman Islands and the growth of reinsurance there. Is that a district you're looking at more closely?
No, we're pretty comfortable where we are at this stage. We have maybe a small subsidiary in a spot or two, but it's for a very specific reason. But I think our core will remain where we are.
Great.
Yeah.
And then back on AI, I mean, it's both transforming insurance kind of within insurance companies in terms of their operations, and then externally in terms of the risks that you underwrite, maybe starting with the operational side. I was trying to ask earlier whether it creates a talent problem where kind of early career talent doesn't have as much to do when it comes into the insurance business. Is that fair, or how are you using it internally?
So I think the AI discussion for us falls really into three main buckets, and I think it is for kind of everyone. There's efficiency, there's insights, and there's innovation. And there's lots of offshoots to each of those. But I will say, just as a general comment, not the either or. I don't think it replaces the human. I think it's human and machine kind of that have to figure out how to work well together. I was at a recent conference, and there was many tech CEOs who were giving their commentary about this AI trend and wave, and I would say it was very eye-opening to me. And I'm sure there's many here are much more informed than I am, but it was very pragmatic in how they were delivering the commentary and the amount of investment that's happening. One of the CEOs from a very large company said the shift from on-prem to cloud was a 2 to 3x uplift and kind of output and economic activity. And someone asked, well, how does this compare? How does AI compare to that? He said, don't compare them. This is a absolute tectonic shift. It's a complete redo for kind of everything. So it's not. So I think just there's two ways to look at that. We can kind of argue with it and say no, it's not, and hope for the best. In my chair, hope's not a great strategy. That's a kind of a risky one. Look, I think there's ways to think about that, to embrace it and to learn, but it's very much a dynamic where I think we all have to figure out how to embed it. How do you embed this into your organization? How do you embed it into your talent plans and the talent dynamic? Who you recruit, who you bring into the organization, and how do you train up? So I think there's so many dimensions to that, but to the broader question about talent, I would say I'm on the more optimistic side of that equation. And I can only look at our example. We run a global internship of it's about 55 or 60 individuals we bring in every summer. We had 7,000 applications for it.
Wow.
So you guys are doing a good job. I mean, there's obviously some interest.
Did that go up recently? Have you seen an increase in interest?
A little bit, but it's been pretty interesting. I think the dynamics that we see are very diverse group of backgrounds and interests. And we as a specialty company do a lot of different things. So sometimes it just resonates with a potential candidate. But you can also see the uptick, I would say, in interest in some of the academic programs that are supporting interest in our sector. So, and I think we've heard a lot of interesting things today. So I'm optimistic this combination of technology and talent, inclusive of who we're bringing into the organization and how we're thinking about this, will all of our organizations, I think, will be a pretty powerful combo in the years ahead.
We were just chatting about the AI theme before getting on stage, and I think agreeing that there will probably, among the hyperscalers, it seems like, be kind of big winners and big losers out of that trend. It's not going away, but that we'll see how it shakes out. Is that also true in insurance or in the risk management space? Like, do you think there's kind of enough AI risk to go around for everybody, or are there people who are early to it and going to do it much better?
Well, I think it's an interesting subtext here, which is as these new tools and as these new insights come to bear, and inevitably scale is going to help in that in terms of the investments you can make. But I also think what it kind of points to is one of the points of competitive differentiation is less about where you play, kind of what lines of business you're in or what jurisdiction, it's how you do things. And so if you believe that how versus where, and there's a lot of, I think our friends at McKinsey did a study on this and showed what percentage of actual, and this is for the public cohort, what percentage of shareholder return was driven by how versus where. It's like 2/3, 1/3. So if you bake into the how technology, right? So technology creating efficiency is one thing, technology completely changing your processes is another. It will do both. It's inevitable. So I think if you think about it that way, then you'll see this growing polarity of winners and losers. And that too is inevitable. But look, we're in a collaborative yet competitive industry, always have been, and I don't think that's totally unusual in that dynamic. I think you might find some accelerants to that as time goes on.
Maybe I have one more question, then I want to open it up to the audience. We've been focusing on the carrier side and how carriers are changing and becoming more capital light in many cases, the private capital coming in there. What about the distribution and the broking side? Like, what are some of the changes you see there? What excites you in broking? Yeah,
another rapidly evolving part of our ecosystem, right? Distribution is evolving in multiple fronts, not just consolidating, but this sort of trend we kind of consider this sort of disaggregation of the value chain, where one of the ecosystems we all live in, whether we call it this or not, is the, for lack of a better description, the frenemy ecosystem. Like your friends today, competitors tomorrow, and that's just as a reflection of the evolution of business models that have happened. So.
Of competitive markets.
Competitive markets. Look, I think any organization has to kind of think about agility as a part of your organizational concept. You have to think about speed, engagement, just the pace of change is so profound. So how do you organize around those principles? And think about it. If you think about how distribution has evolved, you asked a question earlier to one of the panels about facilities, right? That's a very big trend. And so how do you lean into that? Where do you lean into that? And what do you like? What do you not like?
What do you not like about facilities?
Well, I have some colleagues in the room. They'll tell you a whole bunch of stuff we don't like, but we tend to be more kind of specific about areas of the business that we're willing to kind of partner with. So I think, look, there's all sorts of different walks and types, and I think a question was asked earlier about MGAs, where MGAs playing, and they have a very valuable role. Great innovators, wonderful innovators, and I worked in one in my career. I worked at Victor O'Shinner in the early days of Victor now. That created the architects and engineers market. So, and by the way, that was in the 1950s. So they didn't disregard everything I said about AI. They didn't need AI. They just they figured it out kind of early. But if you looked at how that model evolved, they had very unique partnerships, sponsors from the American Institute of Architects and the National Society of Professional Engineers, and they created their own little ecosystem. So I think there's going to be lots of different elements of how distribution deems or what they prioritize really as a means to add value to clients. the key for those of us who assume risk is your organization has to be adaptable enough to wrap around a wider range of solutions in ways that risk will kind of find its way to your doors, and that's the challenge.
Great. Do we have any questions in the audience? I know it's getting to that time of day.
In a perilous spot between your break.
You guys think about it. I have another question on MGAs. It
Yes.
seems like you're almost maybe taking a different view, disagreeing with our panelists this morning. I mean, I feel like I heard a lot of concerns this morning. Just Andy. Okay. Well, no, but that it seemed like a big theme this morning was, concerns about whether MGAs in general are aligned enough with balance sheets and whether they could be taking on too much risk, basically. Do you think that's overstated?
Well, again, I don't think any two are alike. So I think there are situations where there's great alignment. There's others that maybe there's not as directly aligned. Doesn't mean they're misaligned necessarily. They just might be after different things. I would agree with the notion that those who have been in this space for a long time, who differentiate in some basis of underwriting excellence, unique technology, or perhaps a unique way from a distribution perspective to get to a market segment that might be more difficult, they tend to have more sustainable competitive advantages over the long haul. How they mix and match capital and how they think about that and how that relates to cycles, I think that's all going to be TBD. But we see very sophisticated and we see perhaps less sophisticated. So it depends on sort of, I think, what you're looking for. Great.
Maybe I have one other question on capital and sources of capital. You were saying right at the top that, in addition to private capital, which we've been emphasizing, traditional reinsurance capital, you have clients and they're bringing captive solutions. And that just seems like an incredibly complex chain to manage, to think about all those different bits of the ecosystem. Is that wrong? Is it like capital's capital and it ultimately makes the same kind of yield wherever it plays? Or do you treat those different investors differently? Like, do you have to manage your relationship with them differently? And do you offer them different kinds of risks and liabilities?
Yeah, I think it's probably more the latter. So we, in addition to sort of our core balance sheet businesses, we have a third-party capital business called Leadline Capital Partners. And within Leadline are a combination of property and casualty solutions. And the investors into Leadline all have different risk return parameters that they're looking for. We just launched Wayfair Re, which was a very large casualty sidecar, casualty only. The investor into that vehicle had a very specific timeline what they were looking for in terms of the asset, like for our prior panel, the asset liability matching was a little bit different from what others are looking for. So I don't think it's one size fits all. I think it's about matching whatever a certain investor is looking for, but I think having that optionality to offer multiple solutions along those lines is quite critical.
Do you find yourself trying to originate more slightly longer dated risk in order to, given that that's where the demand is? Like, I don't know, would that be casualty or what would that be?
There's an interplay between your kind of the front end portfolio, the gross portfolio, and how you match that risk to capital. But we don't change our underwriting parameters at all. In fact, one of the real leverage points I think for anyone will be demonstrating a long-term track record of underwriting profitability. So by virtue of having some of this additional capital, you can't let the tail wag the dog kind of thing. So we're trying to be very, very cognizant of how all those play together. It's putting the puzzle together, which is something our team's really good at. But inevitably, look, our core balance sheet, our principal shareholders, the Canada Pension Plan Investment Board, CPP Investments, and they have one profile, and people who are into Leadline have another profile. Some who are into other parts of what we do in London and our consortium business have a third profile. But I think that level of kind of customization, specialization, and matching the return profiles to a wider range of investors will be something that's only going to grow, certainly in the world ahead.
Yeah, and on the point about not letting the tail wag the dog, that's a nice insurance pun. I guess I wonder, with those slightly longer dated lines, there's more room to do interesting stuff on the asset side, to take advantage of the illiquidity premium, to pick up on the last panel. But I guess it takes a longer time for risks there on either side to develop. Do you have any concerns about that that direction of travel? I mean, I think we hear about this more on the life side of things with the growth of private credit and actually illiquidity isn't a bad word, but more sort of the credit risks that we see in some of those portfolios. Are you worried about that trend migrating into P&C?
Well, I think the and any one of us in the space, we're asset managers to begin with. So we run a very large asset portfolio and have all the apparatus around that. The nature of certain investors matching an asset strategy to a certain liability duration is going to be a little different. But in the long dated lines, the casualty lines, for instance, where do you settle on taking back the tail? Where do you settle on what an ultimate policy period is going to look like? That's all in the structuring. So we have taken that very much into account and thought about a much longer dated dynamic. But again, as the asset side gets a little bit more, and we heard about the privates and other things, as there's more strategies brought to bear, that creates a little bit more optionality to make sure the structure on the front end is correct and it has the proper dating on that. So but I think inevitably you're going to see more and more and more of this. It's not just property, it'll be casualty, it'll be the specialty lines. And again, I think you'll have a lot of customized product that will match to a certain investor's appetite and that duration.
Really exciting time. Thank you so much, Jonathan.
Thank you.
We're out of time.
Yes,
Great
thanks.
conversation.
Good to be with you. Thank you.